Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. We're going to go over a lot of data that's going to show you guys and paint a picture of what's really happening with foreclosures. Do we have a record low foreclosure rate overall? Yes, we do. Why do we have that? Well, overwhelming equity and things of that nature. Now, the thing is, guys, the dynamics of the housing market and the dynamics of the economy are changing greatly. There's a less and less spending going on, which is especially important to understand because our economy is run off of poor spending habits of consumer. We're a debt-driven economy. And so now that we're getting closer and closer to recession, probably already in recession, people will stop spending as much money and they will go back to saving money. And so today we're going to go over all of the updated foreclosure information because Black Knight has their new May report out, which looks like this. You guys, there's about 27 pages. This will be linked in my description. This goes over so many good things. So it will be linked in my description. And in addition to that, we're also going to go over what was going on right before the GFC as far as what were interest rates doing, what was unemployment doing, and importantly, guys, what was savings rates doing right before the GFC? I think it's really, really important to paint that picture for you guys, even though the GFC was different, just to show you guys, honestly, how quickly things can change. Because remember, during the GFC, almost all of America was blindsided. And I don't want you to be blindsided too. And real quick, guys, before I really dig into the data, big shout out to Jason Walter for helping me with the editing. If you guys need help with editing, if you want to be a YouTube content creator, reach out to Jason Walter. His information is in my description. He's a great man, and a big shout out to you. Once again, thank you, Jason. I wish you nothing but success. Now, this is where I'm going to start, you guys, because to me, this is the most revealing thing. And I'm going to tell you guys what's going to happen from this chart alone. So this is the delinquency rate of mortgages that were originated within 6 months. Now, first of all, let me explain to you my experience. So I used to be a branch manager over 3 branches. And basically what that means is I ran a P&L, a profit and loss form. Now, I could tell you guys that if I had something called an EPO or a mortgage that had a late payment, I would be charged back all of the profit. And so what you see here, the increasing delinquency rate in our new originated mortgages, what I want to point out, this is absolutely murdering regional banks. As a manager over 3 branches, if I had 2 to 3 EPOs or delinquencies in the first 6 months, my whole branch would go under. So even one of these is a big deal. And what I want you guys to pay attention to is essentially every category, conventional, FHA, and VA loans are all near a 10-year high. You guys, sitting back at about 2010, you can see right here, even conventional, and these are recent loans, is at 2010 levels, as is VA right here and FHA right here. So we are at 2010 levels, okay, of delinquency for originations 6 months. If you guys thought that there was a whole bunch of pressure on the banking sector from CRE and commercial real estate, also understand that what you see right here is absolutely destroying them. And as we go further into the recession, more and more delinquencies will surge like this. And what this all leads to, guys, is credit tightening. And what does credit tightening lead to? Less spending. What does less spending lead to? Recession, which leads to unemployment, which leads to reset. So it is undisputable. We have skyrocketing delinquencies in people that just purchased, which again further illustrates the difference of homeownership pre-QT and post-QT. If you purchased a house before quantitative tightening, depending on when, you probably have a lot of equity and you probably have a low interest rate. But you fast forward into 2022, people have higher interest rates, and you're lucky if you have any equity at all. And so the difference of home ownership is so divided, just like millennials and boomers, real, nominal, rich, and poor. It's greatly divided. Now, I'm going to briefly cover this week's stats, you guys. So delinquencies right now is sitting at a historical low at 3.2%. Now, remember, Black Knight gets their data from like credit providers and things like that. ATTOM gets data from county records. The problem with doing the county record things, not that it's a completely bad idea, it's just some states are non-disclosure like Texas, so they'll never have enough information to really know what's going on as far as the intimate details. But we're sitting at now a 3.2% delinquency rate. I do want to point out that that is down monthly, and that is down also, you guys, year to date, but it is up year over year. So we are up year over year, 9.4%, sitting at 3.2. Now, as far as foreclosures, very, very low. Okay, that's only a 0.38%. That is also down year over year and month over month. Now, as far as foreclosure starts, we had an additional, 26,000 homes start the foreclosure process. All right. So in 1 month, 26,000 people started the foreclosure process. That means 26,000 families. So maybe double that are no longer have purchasing power. Because remember, one late payment, just one, can drop your credit score 100 points. To get to foreclosure, you have to have several late payments. So their credit is gone, unfortunately. Now take a look at this, guys. Here may be the most important thing to take a look at, which is serious delinquency. So serious delinquency means they're 90 days or more past due, and the next step is basically foreclosure starting. We're at 1.2%. That is high. Again, we'll look at 2006, and I'll show you. However, that is down month over month, and that is down year over year. So probably what's happening, guys, is loan modifications working. Quite frankly, I mean, when we went through the GFC, loan modification was fairly new and no one knew what they were doing. Fast forward to today, these banks are experts in loan modification. I mean, that's a fact. But what we're focusing on, again, is purchasing power. Because remember, during the GFC, there was less than 300,000 homes sold as foreclosures. About 300,000 homes, guys. That's it. Not 5 million, okay? There were 5 million, or there were millions of foreclosure filings, but the ones that actually made it to foreclosure, it was a few hundred thousand. Not a lot at all. Now, as far as new originations, take a look at this. This is bad, you guys. 325,000 households that have destroyed their purchasing power and can no longer really spend in the economy. So those are the people that are going to suffer. Obviously, they're going to spend less and they're going to try to catch up, and hopefully, God willing, they'll save money and they'll get ahead. But regardless, you guys, 325,000 more families. And believe it or not, that's low. Can you believe if that's low historically, then we need stricter lending guidelines. We need stricter lending guidelines if 325,000 families is low. You guys agree with me? Now look at the trajectory of total delinquencies, and you can see this is where there is year-over-year growth. Now, generally, you guys, you can see, April of 2023, it actually went up. So, pay attention to April once that comes out. Not 100% sure, and unfortunately, in this documentation that we're going to go over, I don't have the updated COVID forbearance plans that have been deteriorating, that have over 300,000 families in it, that are not in this data. So unfortunately, they didn't give us that info. But again, there is a crisis forming in the people that are still, after all these years, in the COVID forbearance programs. Again, those programs are unraveling. You guys, just some interesting stats real quick as far as the worst shaped states, starting with Mississippi. So Mississippi is in the worst shape. You guys, the national average, again, is about 3.2% for delinquency. Mississippi's sitting at almost double that, actually more than double that, at 7.1%. Louisiana is at 6.6%. Y'all see that right there. Alabama, 5.3%. So all of those states are right next to each other. Very interesting to see that. Now, number 5, very shocking, Arizona. How is Arizona? You guys, Arizona is up. If you look here, okay, yearly change in non-current, 9.7%. That's pretty surprising that Arizona's there, don't you think? And if you guys have any intel on what's going on with Arizona, let me know below. But I could probably tell you right now, it's the job market and unaffordability. Am I wrong? Let me know below if you have intel. You guys, this is going to be a little bit harder to see, but I'm going to zoom in real quick and let's kind of just look at this right here. Okay, is really what I want you guys to pay attention to. So this is at the end of 2006. Okay, so at the end of 2006, you guys, there was 106,000 foreclosure starts with only 32,000 completions for the entire year. So again, there wasn't million. And in 2007, you guys, completions 51,000. Under that, for 2008, 59,000. For 2009, 99,000. For 2010, 79,000. There was not millions. There was, however, look at this, guys, there was, however, millions of people that were non-current. You guys see that? And that's what I'm trying to explain. Yes, we had a foreclosure crisis, okay? And what handled that was loan modifications. But the true problem with the GFC, again, was investor speculation, all of those bundling of subprime loans, and people lost their purchasing power almost overnight. I mean, look at the numbers that I circled. Millions of Americans lost their purchasing power. And when you have a foreclosure filing, you lose your purchasing power for years at minimum. But I also want to point out this, you guys, serious delinquencies, okay? It's kind of hard to see, but right now we're sitting at 435,000. In 2006, we were at 538. Okay, so again, 2006, we're at 538. Right now, we're at 435. But here's the thing, guys, when we add those COVID people in forbearance, how much is it really? Again, When we count the COVID forbearance program that are deteriorating and we add that to the 435,000 people that are non-current, does that mean almost 750,000 people are non-current? Or does that mean 3/4 of Americans are serious delinquent? Or is that info included in there? I don't think it's included in there. I mean, honestly, guys, when someone's 90 days late and then they go onto a loan mod, they start over again. They're no longer like 30 days late. So I wish we had like a separate category of information that explained to us and showed us like how many Americans are in forbearance, because that will indicate to us how many recent homeowners have lost their purchasing power. Now, here's a chart that really demonstrates what happens after recession. People are like, oh, it hasn't happened yet. It hasn't happened yet. But it's like, yeah, right, because we haven't had recession. So anytime a goalpost is kicked, it's because the recession has moved down. And why does this recession move down? Government deficit, government jobs, bank term funding program. I mean, the list goes on and on. But nevertheless, you guys, right before we entered recession right here, okay, we had a similar foreclosure inventory situation. So what I want to explain to you is, yes, although the numbers for foreclosures are historically low, do not forget, and some of you may not have even gone through this, but do not forget the foreclosure crisis didn't even happen until we were already in recession. And then it absolutely skyrocketed. So it does make sense right now that we don't have a whole bunch of foreclosures. We just getting out of like being printed a ton of money. For one, people still have equity and we're not even in recession. But you guys, what I'm pointing out here is when we do enter recession, we can expect foreclosure inventory to skyrocket. Will it get this high? Time will tell, but nevertheless, it will happen once we enter recession. And what does recession have to do with home prices? Well, unemployment. Unemployment, you guys, usually tracks delinquency. Delinquency equals for selling and less buying demand and less purchasing power. And what I wanted to show you guys, this is the time frame right here leading into the GFC, and this is the unemployment rate as tracked by Fed economic data. So again, when we started in the recession, way down here, okay, the unemployment rate was only slightly over 4%. Okay, so it was about 4% plus, so slightly over 4%. Right now we're at 3.9%, but the unemployment, this is again what I'm trying to explain. Here's the recession from here to here, you guys. The unemployment didn't even start happening until we were in recession. Do you guys see that? So even though the recession started here, unemployment went down initially. Unemployment went down initially during the recession, and then eventually the economy and the world woke up, and then that sucker skyrocketed up from in the 4% all the way up into the 10%. June 2009, it was 9.5 right here, but you can see it entering 10% unemployment right there. And obviously, guys, it was that way for a substantial amount of time. So it's not fair to say that the labor market's strong because we haven't entered recession yet. If the labor market's strong, unemployment won't go up during a recession, right? But again, we are very close to where we were at right before the recession. We're at 3.9. Right before the last recession, we were slightly over 4%. I mean, you guys can see when recession comes, it hurts almost everyone. Now, the people that are prepared could potentially become rich. And the thing is, guys, when recession happens, usually you have two things happen. Not only do you have prices go down, you also have interest rates go down. So I'm hoping that we're going to be in that environment when we're purchasing houses, when prices are going down, and at the same time that interest rates go down. But what I want to do, guys, is again, I want to show you this is where we were at going into the recession. So going into the recession, we were sitting in the 6%. Okay, so about 6% plus, a little over 6%. Now, when we entered recession, obviously, it kind of held for a little bit right there. And obviously, you guys, a lot of times they lag on determining whether or not we're in recession. So once they finally figured out we were in recession, look at what happened to the interest rates, okay? They started cutting them sharply. So interest rates went from 6% all the way down to being in the 4%. You guys can see that right there. So again, the interest rate cuts, okay, substantial cuts did not happen until we were already in recession. In fact, until we were well in recession, we didn't even start really significantly cutting until we were more than halfway through. So for the people that think that the Fed is just going to cut interest rates, let me ask you this question. Why? Absent a recession, why would they do that? Because what you see here, guys, okay, this time frame right here of these rate cuts right here, and what you see here, guys, in this time frame right here, is you see the Fed trying to stimulate the economy to bring it back to life. And that's the same exact thing that will happen this time around. Now, in addition to all those things, guys, remember our economy is based on consumer spending, okay? And obviously a lot of those are horrible spending habits. And what I want to show you here is the savings rate leading into the Great Recession, okay? So the savings rate going into the recession was 2.4. Right now, you guys, I think it's 3.2. So it's very similar. It's in the trash right now. But what this demonstrates, guys, is people stopped spending their money and they started saving money. And when people stop spending money, obviously the economy contracts. And to put this case in point, look at how much the savings rate literally skyrocketed into the recession. And look at how much it went down after the recession. You guys, there is so much emotion built into finances and capitalism and just everything in the world. This is so shocking. I mean, we go through this like it seems like every single time. But again, look at guys, it went from 2.4% all the way peaking right here at almost 8% savings rate. So people generally save money through recession, which feeds the recession, which is good for you and I. And what I'm saying is, this is what I'm saying. I'm saying right now, okay, today, save at 20%. Okay, don't wait. Don't wait for the recession. Okay, save in advance so when everyone else stops spending and starts saving, you and I can start spending and stop saving because we can purchase deals of our lifetime. And we already see that in commercial real estate. But regardless, people will stop spending, you guys. It's only a matter of time before all of this falls apart. It's inconsequential of when it will happen. We already know it will. Here's another really, really big important thing that a lot of people either didn't go through this or don't remember what happened, which is basically credit tightening, okay? So all I'm doing, guys, is I'm putting credit tightening standards for credit cards. Obviously, we have a horrible spending problem, obviously. But right before, again, going into the Great Recession, credit tightening was like super low. I mean, like almost anyone can get a loan. It wasn't until the recession that everyone tightened up credit. And they had to do that because banks were going out of business. But what's really interesting is right now, we already have credit tightening going on and we're not even in recession. So what you can expect is us going into recession will lead to additional credit tightening, which means once again that consumers will have a tough time spending money in an economy that is built upon the backs of poor spending habits. So credit tightening will happen. It happened drastically, essentially what it felt like overnight during the GFC. Now, one of the primary differences of what's going on right now versus the GFC is I would say the inflation and unaffordability. Right now, you guys are sitting at a 36.1% national payment to income ratio. That doesn't even count taxes and doesn't even count insurance. Back during the GFC, we didn't have skyrocketing property taxes and homeowners insurance like we have right now. So if you really want a true gauge comparing the GFC to right now, you have to include taxes and insurance. You have to, because it's skyrocketing like we've never experienced before. Now, just to show you guys just how out of whack everything is, let me read this one bullet point. Under current market conditions, it would require some combination of more than a 3.5% decline in 30-year fixed rate mortgages, which would bring them back into the 3%, and or a 49% rise in median income. I'll take a 50% raise, and or a 33% decline in prices to bring back affordability to the 30-year average. I guess what I'm trying to say here by reading that is it's not sustainable. We know that this is not, you guys know that it's not sustainable, right? Like it's just taking longer because of all of the money printing, and that money was printed into our account. So it makes sense. But you guys understand that this isn't sustainable, right? Comment below. Do you think I'm a wacko lunatic like Dave Ramsey calls all the people that oppose his opinion? Comment below. I want to know what you think, but let me show you another map. Now, this map better illustrates the unaffordability. This is the average percent of take-home income. Okay, thank God. So now we have info for net income, which is your take-home income. That also includes property taxes, insurance, and utilities. And everything in red is 50% or more of people's take-home income going to those things. Okay, that's not counting car, vehicle, credit cards, personal loans. That's not counting any of that, you guys. Not counting school, not counting nothing. Look at how bad a shape America is in. The only reason this is still going on again is because of the excess savings that we've had and the fact that consumers pay down their credit cards. We know that. This, what you're looking at, is so unsustainable. It's crazy. Now, if you look here, guys, this is probably where I'm circling here. This is probably why, like this area that I circled, that's probably why it's been a little bit more resilient when comparing other parts of the nation. You have two things going on where I circled. Number one, you have more affordable housing in comparison to the rest of the nation. For the locals, it's not. You've already priced out the locals, so that's horrible. But in comparison, it's still relatively affordable, and there is a lack, unfortunately, a lack of new home building going on in those areas. But what's really astonishing is everything outside of those areas is red hot, especially Florida once again. And look at Texas. What? And then Texas is all messed up. Obviously, California and the West Coast is always messed up. East Coast is always messed up. But look at some of these states right down in here that are still relatively affordable. I don't know if I believe that. But regardless, we're having an absolute consumer purchasing power meltdown. We have a meltdown in consumer purchasing power. Astonishing, absolutely astonishing in the front end of a recession. Let me show you guys one more thing. We have signs of distress in the housing market right now. In fact, we've had that. And if you think, oh, we're wrong, it's just seasonality, ask yourself, why did house prices go down in 2022 at the rate they did? And why did they rebound in 2023? If you ask those questions, if you follow the trail, things will make a lot more sense, and it will be easier to move through this really, really choppy market. Obviously, it's very confusing. I have over 20 years, and it's still even confusing to me sometimes. But look at this, guys. It's like spring home buying season, and they're all already metro areas that are showing month over month price decline. You can see that right here. You can see that right here out west. You can see that here in Texas, and you see it all over the place in Florida. So my bet with Melody, as far as Texas is going to lead Florida from a price decline standpoint, Florida's catching up rapidly. I mean, seriously, guys, Florida, everyone's talking about how resilient Florida was, but now look at it. Now it's in the ditches, and it's only going to get worse as time goes on. I mean, seriously, think about it, you guys. We have a presidential election this year. When did the GFC happen? When did it happen? It happened during a presidential election. At least it started during a presidential election. The presidential election, the fiscal policies, the monetary policies, all that is doing is making things worse. If we would have just maintained the correction and the crash in 2023, we wouldn't have such a high bill to pay. And that's my opinion, you guys. Again, I don't know exactly when it's going to happen because I don't know what the government has planned as far as additional things are going to prop up. But make no mistake, it doesn't matter when it's going to happen because we know historically it will happen. But if you disagree with me, that's fine. I want to know how you feel about that. And all of this to say, all I'm saying, you guys, is be careful. If you can wait, you should probably wait. If you have to buy right now, please understand what I'm saying. And if you're going to buy right now, it has never been more important to purchase real estate with fundamentals. And if you don't know what fundamentals are, I have a free home buying course I made for you. Now, if you want to be even more savvy, I also made a free subdivision analysis form for you. I'm trying to help our community and lead us together into becoming winners in this insane housing market. And I hope you guys see how sincere I'm being. I'm not after money. What I need to sustain is I need to know beyond a shadow of doubt that I'm truly helping people. And I hope you guys can see that. And other than that, guys, I'm going to get out of here. And if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win.